All right, all yours.
Well, good morning, everybody. I'm calling in from Newport Beach, California, where it's 6 a.m. in the morning. We are a venture fund solely focused on the blockchain space, albeit we call it a little more nuanced than just blockchains. We call it decentralized software solutions. We've been in the space since 2008, which probably sounds really odd, but I started a discussion group in 2008 on Facebook, funny enough, on the decentralization of the web after I sold my last startup. As you can hear my voice, probably I'm originally from Germany. I was a software developer for a very brief period of time at Siemens Nixdorf in the 80s, went to law school afterwards, and then joined one of the first internet service providers as their general counsel. And we just get very lucky to sell that company at the height of the .com to what's now the largest internet service provider in Europe. I promptly retired from the law and moved to Southern California, where I still am today. And our original fund in 2000 focused on voice over IP solution, multi-massive online player games, which probably, as you guys realize, shares a lot in common with what we focus on now, the blockchain space. My partner founded the Ethereum meetups here in Orange County. That's how we met. And we discovered we have the same outlook on investing in these solutions, which means we're taking a very thesis-driven approach to investing, a very academic approach. So what I'm presenting now is coming backwards from the highlight of what we kind of want to see develop within the next 5 to 10 years, taking the approach of where Web3 needs to be to kind of mitigate the sins of the past using the paradigms of fungibles and non-fungibles. First, we skip through the usual disclaimer. This is obviously not investment advice or otherwise advice. Here are a couple of companies that we affiliated with, that we invested in, that a lot of people probably would know. So I might mention those during the presentation, just so you know we have a financial interest in these entities. So at a very high level, the way I like to look at this technology of decentralized software solutions and blockchain in general is we started facilitating economic activity with things like paper. Then in the 80s, we moved on to database solutions, or actually the 60s we moved on to database solutions. And then we made a rather big mistake. We connected these database solutions to networks, including the internet. And the reason why this is a mistake is because you cannot protect database solutions. It's impossible to do. And so that's the main mistake we are rolling back right now. And then you probably realize the symbol on the right represents databases represents cryptographic primitives, either mapped to graphs or mapped to blockchains in particular. And I get into why this is important. So what's interesting about fungibles, and specifically fungible bearer instruments, and most people realize that, but I'd like to remind everybody of that. It's an instrument I can give you, I can prove you visually that I don't have it anymore. You have it, you have control over it, and you can do whatever you want with it. Albeit that's really not true for the US dollar. You get limited use rights. Actually, if you deface it or do anything to it to make it unuseful for its intended purpose, you can actually go to prison ultimately. So more interesting, what did the Bitcoin white paper introduce? It introduced a number of things, but here we'll focus on the digital bearer instrument. So the idea that you can do the same thing that you could in the physical world with a bearer instrument in the digital world. I can provably hand you something that I don't have anymore, but you have under your control right now. We have a couple of different standards. I'm not going to bore you with the details. We're just going to use Ethereum as the most widely used standard. So you got ERC20 for fungibles, ERC721, ERC71155, where we had a hand-on for non-fungibles. And another interesting standard that people should know about is ERC998, which is actually the idea that tokens can own tokens, and that will actually become way more important in the near future. So what are some of the fungibles? There is about, I think, 400,000 of these right now on Etherscan. These were the top yesterday when I copied them over. And we like to look at those each on an individual basis. Yes, you can classify them by utility, by security, and otherwise useful categories like stable coins, albeit All of these solutions are obviously built on open source stacks. They're all smart contracts of source, standardized smart contracts, and they're also in flux. They're in flux in terms of the development of the underlying chain. They're in flux in terms of the associations you can create to those chains, i.e. things such as we've seen recently, governance tokens. So I get why this is important. So the previous speaker already pointed out to some of the markets. So for this particular speech, I divided this into the fungibles very loosely into bonds, equities, and fiat currencies. And then just to showcase the little speck on the right-hand corner is what we perceive to be the crypto markets today. And you probably saw that they're rapidly drawing down at the moment. Doesn't really matter as far as I'm concerned. This is one of the typical cycles, I presume. But the larger point there being is you want to look in all of those categories, what are the actual use cases? And the reason why I say use cases is a lot of times people still conflate the functions and the use cases of these instruments. What do I mean by that? So the primary use case of fiat currency today is lending. And lending is mostly done, as you guys know, by commercial banks, and also the creation of money is done by commercial bank. The reason why this is important is if you want to address any of these use cases, you have to actually realize what these particular use cases are. Fiat money in digital form, and 97% of all fiat money only exists in digital form, exists in a constant state of lending. Even the money that you perceive to be having under your control in your demand deposit account, what people call their checking account, is not your money, is in a lending situation. Oh, and someone said I'm supposed to be sharing and I'm not, so my apologies for that. Let me try to fix that. Select files, select screen, and we're doing it again. Thank you for pointing this out, Mark. Okay, so you heard all of this in a vacuum. I hope it still makes sense. Otherwise, I'll jump backwards sometime later. All right, thanks again. So moving on, one particular anecdote I always like to mention. Yes, in the real world, we got fungibles and non-fungibles, and fungibles are typically the paper money that I showed earlier, but are coins fungible? Coins are fungible if and when and where they consist of the same metal, but if you have a coin that was minted in 1969, I would not recommend that you're trading this for a 25-cent item. I explain why that's important. So what are the market sizes of the non-fungibles? We talked about things like real estate earlier in the presentation. Then the next largest market sizes are things like car sales, retail sales. And again, just to illustrate where we are in the current paradigm of what we call digitally native items, it's really tiny. Maybe to point out, the market sizes on the left, they're all shown in trillions. So it's not to scale what I show you in terms of in-game item sales or collectibles. They are really negligible in terms of real-world economic activity. And that's kind of the lens that I'd like you to use, real-world economic activity. How can the paradigm influence real-world economic activity at scale? And I'm bringing this to a larger level in the later slide. So how does real-world economic activity work today and has worked for millennia? So someone has an idea and needs to instantiate that idea by maybe raising some money or borrowing some money. Then maybe we are growing grapes, or maybe we're buying a house or building a house and buying some lumber, and then we're adding some value to it. So in this case, we're bottling that wine, and then we create a record of that wine so that we can ultimately enter this into a sales tool of sorts, which is typically a database right now, and it enters the supply chain, moving along into different databases, and then eventually ends up in a cash register, and then ultimately ends up in your hand. So why am I making this example? The example is that all of these data silos have enormous flaws to it. There's a lot of loss within that particular paradigm. All of these real-world items will, in my opinion, have digital twins or digital clones, depending on what vernacular you like, in the near future. And this is the real utility, and this is where all the value is being created. And by this, I mean the on and off ramps to the digital world. So economic activity tomorrow, as we envisioned and outlined 3 years ago in terms of NFTs, could look like the following. You have an idea, I instantiate that idea in an NFT, and then NFT representing a real world item. Let's recall our grapes. So we add our grapes into the supply chain. We follow the bottle along the supply chain, attach some metadata to it, maybe using IOTA or another blockchain to that NFT, and then ultimately handing it over to the cashier. And at the moment you receive that physical item, you receive its digital twin with all its metadata that you should have had all along. So here is how this could look like, and this was a call to action we made to users in our Ethereum meetups over 3 years ago. And by the way, if you attended this meetup and received an NFT, you should look up how much it's worth today, please. So now to the most important part that I want to point out. That's a common kind of oversight through all the projects that we saw over the past 5 years. We looked at 600-700 projects. And there's a common misconception what is being built. What is being reversed is on surface level, the centralized web, the idea that very few companies control access and distribution on the World Wide Web. By all accounts, Google indexes maybe 4%, probably less than 1% of the World Wide Web. You're not Googling anything. What you're actually doing is you're running a query against their index, and this holds true for any of the silos that you're entering. The reason why this is important is the following. You're accessing these databases with whatever limited choices they want you to see, and they use what we call social engineering as a service to move you down the product purchase line. And at the ultimate stage, you're kind of an endpoint that information is being pushed to. So the larger paradigm to understand here is the following. The decentralized web will treat you no longer as an Oracle function. What I mean by that is an Oracle function is an entity, an item that spews out data that the network collects and then reacts to. If you're putting an A into the Google search engine, it will already suggest to you certain results that are different from mine, influencing you in a way that is conducive to the ultimate objective of that particular entity, which ultimately is always the same as the increase of shareholder value. So the difference now is we will still use the Web 1 layer, so the FTPs, the SMTPs, the HTML layer, and built on top of this are blockchains. Oftentimes, blockchains are called protocols. I think from a technical level that it's rather inaccurate, because blockchains are actually making use of all the existing protocols that make up the internet today. And then ultimately, on top of these blockchains, we build decentralized applications. The larger point here, though, is that the decentralized net is going to treat you no longer as an Oracle function, but as an agent in the system. So that could be by an NFT that provides you voting rights, could be by an NFT that provides you with the rights to a real world item. And in more granularity, I like to visualize it this way. And there's a bunch of companies out on the slide that we already invested in that make up this infrastructure. So on the bottom line, you have the Web 1.0 infrastructure, then you got blockchains on top of that. And then you got decentralized naming, addressing, decentralized bandwidth, decentralized storage, and so forth. And then for the time being, these going to be the most important layers. It's all the on and off chain services. How do you get real world items into these systems, onto these systems, onto control? And then ultimately what people like to call wallets, which are really browsers to the blockchain, because obviously you don't hold any of those NFTs, any of those tokens in your wallet. These are just metaphors that unfortunately lead to a lot of confusions. So lastly, all the value, maybe not all the value, but most of the value is going to accrue to the decentralized applications running on top of that infrastructure. We are still far away from all of those. Anybody using things like security tokens or equity tokens today is mostly misguided, because The reason being here, as an infrastructure play, as a technology setup, these are all key lock systems. What I mean by that is you are the key ultimately. And the single most important development that a couple of teams feverishly are working on right now is quote unquote solving the topic of identity. I say quote unquote because this has nothing to do with identity really from a legal sense. It has to do with the fact that you need agency control and attribution that is persistent in digital form. Any implementation that still creates copies, that still anchors any type of PII, personal identifiable data and or assets, and those two go hand in hand, to a blockchain will be invalidated. The reason being, and there's already a couple of papers to that extent out there, is you obviously cannot undo this, and you immediately violate things such as GDPR, CCPA, etc., because you do not actually want copies. What you do want is cryptographic primitives that are mapped to most likely graphs and or being used in conjunction with blockchain-based implementation. So ultimately, it will look like this, and to some extent already does. So you have full control, ownerships and right, and the cryptographic primitives under your control to verify your fiat identity, your government ID symbolized above. And then ultimately, albeit we're probably at least 10 years away from that, are able to control rights to things like your car title. We already have seen ticket implementations. Those are easier. A very crucial implementation right now, because these solutions are being rolled out at the moment, is control over your biometric data and also your health data and your DNA. And then lastly, and this is going to take probably more than 2 decades, the ultimate movement of more complex implementations such as real estate solutions on a blockchain. I know this was super fast. There's a lot of articles over the years that we wrote on this topic, going back to 2018, that you can find on Forbes, and more nerdier one and longer versions of these are usually on HackerNoon. Open to any questions. I know this was very fast.
Yes, so we have a few questions. If anybody has any question, please go ahead and add them in the Q&A section. We have the first question from Claus. Can you comment on long-term perspectives for tokenization? Where do you see the industry heading longer term? Mostly in tandem with the established financial industry or opposed to the established financial industry?
Sure. I mean, that's kind of like 3, 4, 5 questions rolled into one. I despise the term tokenization with a passion. It's one of those useless metaphors, right? So you cannot tokenize anything that's not already digitally native, and that's why whatever is being traded right now, all digitally native projects. Because it comes back to what I said earlier. If you're taking a picture of a house, you didn't digitize the house, you just took a picture of the house. So any physical thing, what you're really doing is that you're digitizing the underlying rights transfer mechanisms. And in cases such as houses, there is many different entities like land registries and et cetera involved that need to exist in this particular way before. Because the one thing to remember, and I should have pointed this out at the beginning of this little talk, is that the token is ultimately the digital bearer instrument of a public blockchain. And if and when and where you actually attach PII or otherwise asset information to that, you invalidate the herd immunity of that blockchain. What do I mean by that? So to make a very simple metaphor, so right now the functions that banks fulfill, to kind of roll it into the second question here, is they mostly have the function of creating money, and that's oftentimes overlooked. 80% of all money is being created by bank by the magic of lending. It's a non-event on the balance sheet, and that's actually how most inflation occurs, but the inflation actually occurs to the asset class, and the secondary inflation incurs to overall money supply. The point here being, as far as the banks maintaining ledgers, I hope in the future that is not the case, but rather we treat them like treat them in regards to them providing us with safety deposit boxes, meaning they have a key, they walk you into a room, they unlock the box, they leave the room, you use your second key to open the box, and you access your assets that you keep in your box. That's actually how this should be in terms of accessing any assets that you provide secondary custody to a third party. They should actually not have insights to that. And we're slowly seeing developments to invalidate the kind of legacy mistakes of the past. And there I mean specifically things like KYC that someone touched on earlier. Unfortunately, we have this indoctrination specifically by kind of misguided lawyers trying to enter the space that educate technologists to actually follow the letter of the law. Your job as a technologist is to implement the purpose and objective of the law. In the case of AML, it's the fact that banks are not supposed to facilitate money laundering, albeit the main culprits in that sense. This is entirely technically possible. What I mean by this, that ultimately only transactions that need to disclose PII are those transactions that involve either certain individuals or certain items. It is already obviously possible in the physical world to do this entirely with cash. The only reason why we do things like quote unquote KYC, which is a subset of anti-money laundering and really a whitewashing term of violating your financial privacy, is the fact that the legacy law was written towards legacy technology, so specifically database solutions. So that's why the current implementation is that of a dragnet approach, because most people on this call, if they look at the last 1,000 transactions, they probably realize this transaction didn't need to have my PII. I purchased a car, I purchased bread, I purchased things of daily use, and there was no reason for anybody to actually need to see my passport, know my name, and obviously the bank actually doesn't even care to know your name and attach it to that. Plus, it also includes the risk. So there's an entirely obvious way of implementing these solutions in a way that actually doesn't violate your personal privacy. And by the way, if and when that and where that happens, it will invalidate all the legacy model, all the legacy dragnet model in the United States. It would be considered illegal search and seizure at that point in time when I have a method of not doing this. Again, this is entirely possible. We have all the primitives that are needed, but unfortunately, what I see on a daily basis, and we looked at 600-700 projects, we have our own classification system for what people call identity systems. They repeat the same mistakes. They're still creating username and password account systems. This is no longer about username and password account systems. So this is about cryptographic primitives under owner control, so that you are only the one that can move the item, and only if and when where there is a legal requirement serving the purpose of the law, not the letter of the law. And at that moment, a court action will be required to actually divulge that personal identifiable data that's sitting behind that transaction. I know that was very high level. I typically given like an hour-long talk just about this particular topic. You're muted, Jenny.
Sorry. Thank you, Christian. So that was a great response. We have about 3 minutes, so we're gonna try to take a couple more questions here. Next question. So actually, a parallel internet and financial network in a post-COVID world. What about the hurdles of this week, like ECB, Chinese government trying to block these decentralized networks?
Yeah, I mean, we have a lot of parallels from the past that we can look towards. My doctor thesis was on number regulation. I never defended it because I ended up writing the deregulation papers for the European telecommunication markets. If you're in Germany, I wrote the regulation for innovative services there. So the point there being is, we have this example of the past already, and a lot of people have made this example of voice over IP, comparing it to money over IP, and you can also see how this game plays out. So, for example, in Mexico, specifically, or Mexico, like we say here, voice over IP was outlawed to protect the government's telecommunication organization. Regardless, people have been using voice over IP in Mexico for a decade because the alternative was metered phone services and people simply couldn't afford it, so they're using it. Ultimately, and we're seeing this already, so with thousands of tokens out there. Ultimately, it's going to be the right tool for the right region. What I mean by that specifically, think of it as least cost routing. So all current systems, and that's A, a facility of the technology, and B, a facility of the regulation that the providers of these technologies, so these database solutions, are subject to, will be least costed around if and when and where they still provide these frictions. And frictions typically in these systems consist of three different things. It's a time delay, it's a fee, and it's some form of opacity, right? So some reason why my transaction either takes a long time, has a lot of fees, or I have no idea if and when and where it actually clears. So the point here being is we already see many of these solutions emerging right now that circumvent this, that follow the path of least resistance, and ultimately that's the job of the technologist. I'll make one particular example. So a lot of people talk about obviously DeFi and the rise of DeFi and the different use cases, and they're specifically stablecoin. So if you break this down and look at the actual use cases, what's the use case of Tether, for example? Tether has the highest market cap in terms of any stablecoin, and if you look into the detail, it becomes very apparent the main purpose of Tether is to stay on centralized exchanges and mostly exchange Tether against BTC. The reason being, I want to stay away from the fees that I incur if and when and where I move back into fiat, because that is causing a fee. So the use case of Tether is to stay on centralized exchange. That's its use case. So the primary use case of fiat money is that of lending. The secondary use case of fiat money is spending. So anybody who has been indoctrinated in this old definition of money as a unit of account, store of value, and medium of exchange is utterly mistaken, because the definition has always only referenced commodity money. Commodity money was at no point in time a relevant technology to manage economic activity at scale. It has always been ledger technologies. It has all going back to cuneiforms, then eventually paper, then databases, and now decentralized software solutions. It has always been ledger entries. So the idea that money had these different confined function is just simply wrong. Money is just a contract in that sense, and I wrote a metaphor for that to make this understandable, but that's one of the largest mistakes in our space, because everybody is starting from this idea that money should be sound and so forth. That is all utterly besides the point. You need to look at the particular use case and how your technology is implementing the particular use case. One obvious thing, if you're looking at your digital wallet, is what do you see in your digital wallet? You see your Bitcoin holdings, and then you see the translation into the unit of account that you understand, into your language of value. That's the remaining function of fiat. It's the language of value. If I'm in the US, I see the translation of my Bitcoin in US dollar. I even see the translation of Tether in US dollar. So, and this is the largest friction. At the end of the day, money and value transfer technologies at large benefit from the network effect. The largest network effect today is the US dollar, and they're specifically in printed form. It's way more censorship resistant than Bitcoin. Bitcoin has lost most of its censorship resistance, unfortunately, due to the fact that most of it's custodied on centralized exchanges. Anyway, it's also a talk that I usually spend an hour and a half. So sorry.
Right. My apologies, but we are now 3 minutes over. So there isn't any more time for questions. But Christian is actually going to join us in the panel, which, if I may have Kyle, Alex, Thomas, and Christian, please take the stage so we can prepare for the panel, which will end the track 1 this morning. So thank you, Christian. That was a great presentation. Thank you, everyone, for participating in the Q&A. We apologize that there wasn't enough time for any more questions, but we will end this session now. Please go ahead and head back to the lounge, and we will start the panel. And for sure, this is gonna be a great one. So please don't miss it. We'll see you. We'll see you there. Thank you.